What if the fund you've been relying on to carry you safely into retirement is quietly bleeding investors by the tens of billions, and you don't even know why? Target date funds promise simplicity. Pick the year closest to your retirement, set it, and forget it. For years, they raked in assets as savers piled into a single ticker that automatically shifted from stocks to bonds as the target date approached. But over the past 3 years, a seismic shift has been underway. In late 2024, Target Date Series suffered a net outflow of $666 million, and by mid-2025, weekly withdrawals topped $2.3 billion from just the most income-oriented vintages. This isn't a momentary wobble, it's a mass exit. So what's gone wrong? Rising interest rates triggered bond losses that these funds couldn't escape fast enough, wiping out promised stability. Meanwhile, high-fee tiers have become leaky buckets, losing investors even as the cheapest quintile soaks up billions in new money. And just when you thought tax efficiency was baked in, year-end capital gains hit taxable accounts like an unexpected windfall. One fund's 4.3% distribution is still leaving retirees on the hook for big tax bills. As generic glide paths struggle to de-risk portfolios at the right pace, many savers are waking up to the fallacy of one-size-fits-all. Sequence of returns, risk, individual income needs, and personal horizons demand a tailored approach, and more people are ditching the autopilot and building custom index mixes, income ETFs, or annuity hybrids instead. In this video, we're diving into the 6 hidden faults in target date funds that have driven this exodus from performance vulnerabilities and fee traps to tax surprises and misplaced simplicity. I'll show you why millions are pulling out before it's too late, and what smarter investors are doing now to replace that safety net with a strategy designed just for them. Because your retirement deserves more than a generic ride, it deserves a plan that adapts to you. Investors have been quietly voting with their feet, yanking billions out of target date funds as they question whether the once-trusted set-and-forget approach really delivers in today's volatile markets. In the fourth quarter of 2024 alone, Target Date Series endured a net outflow of $666 million, a stark reversal from years of record inflows, and by June 2025, hybrid funds, most of which include target date vehicles, saw weekly withdrawals soar to $2.34 billion. Those headlines don't just reflect a temporary wobble, they signal a structural shift in confidence. What's driving this exodus is a perfect storm of rising interest rates, equity market jitters, and the realization that these funds can't adjust their asset mix quickly enough to protect investors. As rates climbed, long-dated bonds within the glide paths suffered sharp losses, and funds designed to ramp into bonds as retirement neared were caught holding too much fixed income with too little yield cushion. When markets swung hard in 2022, Vanguard's 2025 fund dropped 15.5% amid bond volatility. Many retirees expected a safety net, only to find the net had holes. Suddenly, the promise of automatic de-risking felt like a slow-motion trap. The portfolios shifted too late, leaving savers exposed to losses they believe they had engineered away. And it's not just older vintages feeling the pain. Even those further from retirement are rethinking their exposure after watching near-retirement funds bleed assets. Instead of waiting for the glide paths to catch up, millions are choosing to reclaim control, reallocating out of these one-size-fits-all solutions and into bespoke portfolios that respond faster to economic shifts. But that's only the beginning. Next, we'll uncover how fee structures are amplifying the outflow trend and draining even more value from investors who stay the course. The cost of convenience can add up quickly, and in the case of target date funds, that price tag has forced many investors to rethink their choices. While the cheapest fee tiers have pulled in over $80 billion in 2023, the most expensive quintile saw significant outflows as savers realized they were paying too much for a simple glide path. Those headline management fees, often 0.75% or higher, don't sound like much until you do the math. On a $500,000 balance, you're shelling out $3,750 a year, regardless of performance. Worse still, many target date series bury additional wrap or advisory fees that can double your total expense ratio. Net returns tell the real story. In years when stocks and bonds both rally, the fee drag is merely annoying. But in turbulent markets like the 2022 bond downturn, every fraction of a percent counts. A fund charging 0.85% in fees that loses 10% in value ends up wiping out more of your principal than a similar fund charging 0.35%. And over a typical 20-year retirement horizon, that extra 0.5% in fees can snowball into hundreds of thousands of dollars lost. Investors have noticed. Fee-sensitive robo-platforms and low-cost ETF suites are siphoning assets away from the pricier target date tiers. Even traditional mutual fund houses have been forced to launch zero-fee or free versions of popular vintages to stem the tide. Yet, those free solutions often strip out active management or reduce the bond sleeve, leaving savers with a different risk profile than advertised. So, if you're still paying top dollar for a simple timetable shift from equities to fixed income, you're essentially renting an autopilot you can replicate yourself at a fraction of the cost. And with fees eating into returns every year, the longer you stay, the more value you surrender to fund family. But fee fatigue is only part of the story. When markets turn, target date funds can feel like a slow-moving freight train. You see trouble ahead, but you can't stop in time. Take 2022 as a cautionary tale. When the Federal Reserve kicked off its aggressive rate hike cycle, bond yields surged and prices plunged. Many target date vintages, especially those winding down to retirement, held hefty allocations to long-term bonds, exactly the segment that cratered. Vanguard's 2025 fund, for example, lost a staggering 15.5% that year, wiping out the cushion investors expected from their safe harbor allocation. Equities weren't much friendlier, so the balanced mix that was supposed to cushion volatility did little to protect savers. What makes this especially troubling is the rigid glide path these funds follow. As you approach your target date, your portfolio automatically shifts into bonds, but that shift happens on a fixed schedule, unaware of real-time market stress. When rates spiked, funds were already overweight in the very assets that were plunging. There was no quick pivot back to stocks or alternative income strategies because the rules simply don't allow it. Investors saw their retirement runway suddenly shorten as bond losses mounted, and by the time the next rebalance rolled around, it often felt too late to recover. Even fund managers acknowledge the problem. Many have begun tweaking their glide paths, bringing forward de-risking, layering in short-duration bonds, or adding inflation-linked securities, but these changes can't rewind past losses. And for savers within a few years of retirement, watching your nest egg decline while the fund does exactly what it's supposed to feels like a betrayal. That performance gap has driven a rush to more nimble solutions. Customized mixes that can react instantly to rising rates, dividend-focused ETFs that harvest income, or dynamic bond funds that adjust duration on the fly. Investors who stayed passive through 2022 are now acutely aware that the automatic safety net of a target date fund doesn't always catch you when you fall. And for many, that lesson came at a steep price. Year-end can feel like a quiet season until you open your 1,099 DIV and discover your target date fund handed you a 4% or even higher capital gains bill on top of everything else. Unlike ETFs or index funds that use in-kind redemptions to minimize taxable events, many target date mutual funds must sell holdings to rebalance or generate cash, crystallizing gains that get passed through to all shareholders. For example, Vanguard's 2025 target date fund triggered a 4.29% capital gains distribution in December 2025, meaning someone with $200,000 in that fund faced an unexpected $8,580 tax liability, regardless of whether they'd sold a single share. That surprise bill can prompt panicked redemptions, further destabilizing fund flows and creating a self-reinforcing cycle. As more investors flee to cover tax bills, the next year's distribution can swell even larger. What makes this tax trap especially cruel is its timing. It lands just as retirees tally their annual expenses and consider withdrawals, and it often pushes them into higher tax brackets or triggers state tax liabilities they hadn't budgeted for. Moreover, because target date funds near retirement tend to hold more fixed income and dividend-paying securities, the blend of ordinary income and capital gains can skew your tax mix, increasing Medicare surcharges or affecting Social Security taxation. Many investors assume tax efficiency is built in, but mutual fund mechanics differ sharply from ETFs, and those in taxable accounts bear the full burden. The result is a forced sell-off or an unplanned withdrawal, exactly when market valuations may be shaky, locking in losses or reducing the balance available to generate income. Savvy savers have begun carving out taxable slices of their portfolio into tax-managed funds, municipal bond ETFs, or tax-efficient wrappers to insulate against these year-end shocks. But the rest unwittingly find that their one-stop retirement fund carries a hidden tax bill that can derail even the best-laid plans. No two retirements are alike. Yet target date funds treat every saver within a 5-year window as if they share the exact same goals, risk tolerance, and cash flow requirements. That one-size-fits-all model glosses over critical personal differences, your planned retirement age, income needs, healthcare costs, or legacy intentions, and instead forces you onto a preset glide path that may accelerate equity exposure or lock you into bonds at precisely the wrong time. Consider sequence of returns risk. 2 investors retiring the same year might experience vastly different initial market conditions. One faces a bull market, the other a downturn. A generic fund can't adjust for who needs cash sooner, who can weather volatility, or who depends on scheduled withdrawals to cover living costs. Then there's your true time horizon. Maybe you plan to work part-time into your late 60s, or you expect a major expense, like a child's wedding or home renovation, in 5 years. A target date fund won't pause its de-risking schedule or tilt back toward growth. It follows a linear formula that ignores these life stage nuances. And what about income streams? Some retirees need a reliable dividend ladder to cover monthly bills, while others prefer bucket strategies or inflation-protected assets. Target date approaches blend these into a single Morningstar star rating, but they won't swap out asset classes to match individual cash flow demands. This lack of personalization drives many investors to ditch the autopilot. They're constructing tailored portfolios that align exactly with their own retirement scorecards, dynamic mixes that can ramp equity weight back up if markets rally or boost short-term reserves when big expenses loom. Some integrate annuity income floors, others blend municipal bond ladders with dividend growth ETFs. They're not rejecting the principles behind glide paths. They're applying them selectively on their own terms. The result? Smarter savers are rediscovering control, building retirement plans that adapt in real time to their unique financial roadmaps, rather than ceding every decision to a generic fund manager's algorithm. And as more people pull assets out of target date series, it's clear that personalization, not passive simplicity, is the future of retirement investing. Investors tired of watching one-size-fits-all target date strategies churn through their savings are spearheading a customization crusade, building portfolios tailored to their unique timelines, risk appetites, and income needs. Instead of sticking with a preset glide path, they're carving out custom index mixes that blend broad market ETFs, sector tilts, and low volatility funds in proportions that match their personal view on economic cycles. Others are turning to income-focused ETFs that prioritize high-quality dividends or short-duration bond yields, creating a reliable cash stream they can adjust month to month rather than waiting on an automated allocation shift. Annuity hybrids have gained traction too, as retirees funnel a portion of their assets into single premium immediate annuities for a guaranteed income floor, then keep the rest in liquid strategies that can outpace inflation. Technology-driven platforms have turbocharged this trend, offering glide path as a service where you input your retirement goals and risk tolerance, and the algorithm designs a dynamic mix that automatically recalibrates, raising or lowering equity stakes in response to market triggers rather than a fixed calendar. Financial advisors are getting in on the act by overlaying personalized goal-based buckets, grouping assets by planned withdrawal dates, and backtesting each bucket against stress scenarios to fine-tune the mix. Meanwhile, some DIY savers are even employing tax-aware strategies, using municipal bond ladders, tax-managed equity funds, and Roth conversion mosaics to optimize after-tax income rather than chasing the gross returns baked into standard target date funds. What unites these approaches is control. Instead of surrendering to a fund manager's generic formula, customizers choose exactly how much risk they'll bear today, next year, and a decade out, and they can pivot instantly if the economic weather changes. As regulatory scrutiny intensifies around target date product disclosures, and as retirees demand solutions that align with their unique journeys, this move toward bespoke retirement planning is only gaining speed. For those who've already felt the sting of generic allocations, the message is clear. Personalization isn't a luxury, it's the new baseline for safeguarding your retirement. As the dust settles on the mass exodus from traditional target date funds, the next wave of retirement solutions is already taking shape, and it moves faster than the static glide paths you've been sold on for decades. First up are dynamic glide path funds, which abandon the calendar in favor of real-time market signals. Instead of automatically shifting into bonds based on your birth year, these strategies use volatility triggers, yield curves, and economic indicators to dial risk up or down on the fly. If equity markets are heating up, they can lock in gains and move to defensive assets before the crowd. If bond yields spike, they can pivot back into stocks or alternative income streams faster than any preset timeline allows. Then there are income-adaptive funds, designed to respond not just to market conditions, but to personal cash flow needs. Imagine a fund that allocates more to stable value instruments when you're withdrawing for living expenses, then flexes back into growth when your spending eases. Some managers are integrating real-time withdrawal schedules and payout horizons directly into their algorithms, treating retirement income like a living budget rather than a fixed date on the calendar. On the advisor side, we're seeing the rise of retirement as a service platforms. Digital dashboards that aggregate every account, project your individual spending needs, and suggest custom bucket strategies, dividing assets into short-term, mid-term, and long-term modules. These platforms can automatically rebalance each bucket based on tailored risk tolerances, tax considerations, and lifestyle goals, all while updating your plan when life throws a curveball. Even robo-advisors are stepping up, offering smart beta retirement portfolios that blend factor investing with glide path overlays, tilting toward value, momentum, or quality factors at different life stages to harvest extra return without sacrificing downside protection. And for those willing to explore alternatives, hybrid solutions that combine annuity income floors with liquid ETF sleeves are becoming more popular, giving you guaranteed cash flow plus upside potential in one package program. But here's the catch. These next-gen strategies are proliferating quickly, and platforms that don't adapt will be left behind. Waiting too long to leave behind your one-size-fits-all fund could mean missing the window to lock in these innovations at today's fee levels. As dynamic risk controls and income-adaptive models become mainstream, the legacy target date series will look increasingly outdated, and savers still on autopilot may find themselves stuck with yesterday's stale approach while the future of retirement investing speeds by. The choice is clear. Will you stay with a static roadmap, or will you embrace the smarter, more responsive journey that's already here? When you step back and survey the flight from target date funds, it's clear that the era of set it and forget it is drawing to a close. What began as a simple promise, hand over your portfolio to a pre-built glide path and sail into retirement, has unraveled under the weight of high fees, slow de-risking, hidden tax surprises, and one-size-fits-all rigidity. Investors have watched their savings erode in bond-heavy vintages that de-risked too late, then discovered unexpected capital gains distributions in taxable accounts, all while quietly paying extra expenses that could have remained in their own pockets. More concerning, the static nature of these funds fails to account for individual timelines, income needs, and market shocks, leaving retirees wondering why an automatic solution didn't adapt when conditions turned against them. That realization has driven a growing wave of customization. Bespoke index mixes dynamic glide paths tuned to real-time signals, income-adaptive portfolios that respond to personal cash flows, and hybrid structures combining guaranteed annuity floors with liquid ETF sleeves. These next-generation strategies offer flexibility, transparency, and affordability, qualities that mass-market target date series can no longer guarantee. But switching isn't just about chasing performance, it's about reclaiming control of your financial future. Before you chalk the exodus up to market noise, ask yourself whether you're comfortable with a generic blueprint managing your life's work, or whether you'd rather deploy a plan built for your exact retirement roadmap. The window to leave behind stale glide paths and embrace smarter, more responsive solutions is open now, but it won't stay that way forever. As technology regulations and investor demands evolve, the legacy of traditional target dates will feel increasingly outdated, and the savers left behind may find their choices limited and their outcomes compromised. Your retirement deserves more than a generic ride. It deserves a personalized journey designed to adapt, protect, and grow with you every step of the way.